So let's continue. The next topic is valuing a firm with two different rates. So sometimes what happens is a company doesn't pay any dividend for the initial few years and then it starts paying dividend. Then how do you value such companies when they are not paying a regular dividend? So dividend discount model is flexible enough to handle any forecasted patterns of dividends. Here the dividends are zero for the first 3 years and then settle into a constant growth rate, allowing us to use the constant growth rate model as a shortcut. So what does that mean is, I'll open an Excel. So let's say you're investing in a company that doesn't pay any dividend for first 3 years, and fourth year onwards it pays $2 dividend that is growing at 5%. Okay, fifth year on means $2 and then it is growing at 5%. So this is the case. First 3 years there is $0 dividend, then 2% is growing at $2 is growing at 5% for next foreseeable future. Then how do you value this? So first is you use dividend discount model. So let's say rate of cost of equity in this case is 7%. Then first you find what is the value of this stock at the end of third year. How to do it? Value in fourth year divided by cost of equity 7% minus 5%. So it comes to $100 and then you discount it back to today's term. So third year the value is $100. So discount this by 7%. Okay, so the stock price should be $81. So any stock that doesn't pay dividend right now, forecast when it will start paying dividend, assume a dividend growth rate, find the value then, right, and then discount it back to today's term so that you get a stock price. This is how you modify dividend discount model in case it doesn't pay any dividend. So value drivers in dividend discount model. The dividend discount model includes an implicit forecast of firm's profitability, which is discounted back as today's cost of equity. Limitations of dividend discount model. The dividend discount model values a stock based on forecast of future dividend, but a firm's future dividend carries a tremendous amount of uncertainty. So it is difficult to project dividends. There are some non-dividend paying stocks. Many companies do not pay dividend, thus the dividend discount model has to be modified. So the first modification that we are going to talk is about share repurchase. So what is a share repurchase? A firm's use of cash to buy back its own stock. The firm uses excess cash to buy back its own stock. Consequences: the more cash the firm uses to repurchase shares, the less cash it has for paying dividend. By repurchasing the share, firm decreases its share counts, which increases its earnings and dividends on a per share basis. So Apple was in the news for doing a lot of share repurchases. So what is share repurchases? It is a way of giving money to shareholders. How? Apple buybacks whatever shares are there in the market. So what does it do to existing shareholders? So two things happen. Apple has less money to pay dividends, but because it has less money to pay dividends, it is repurchasing its stock. The number of shares go down. The number of shares go down, which, since the number of shares is going down, future profits and dividends increases. So whenever a company does share repurchase, less money to pay dividend right now, but future profit per share as well as dividend per share goes up, right? So share repurchases are considered to be a positive thing. So how do you value such companies who do share repurchases? In dividend discount model, a share is valued from the perspective of single shareholder, discounting the dividends the shareholder will receive. So we have seen it. Price today is present value of future dividends per share. A total payout model is the modification you do when you consider that the company is repurchasing its shares. So how do you modify it? So you calculate present value of future dividends and repurchases. So you also calculate present value of repurchases and then divide it by share outstanding to find the current price. So how do you value a company that pays dividend as well as does share repurchases? Calculate present value of future dividends and share repurchases and then divide it by share outstanding. So let's take an example and understand it. So this industries has 217 million shares outstanding and expects earnings at the end of the year to be 860 million. It plans to pay out 30% of earnings as dividend and 20% of earnings through share repurchases. If the earnings are expected to grow by 7% per year and these payout remain constant, determine shares price assuming an cost of equity of 10%. Based on the cost of equity of 10% and the earnings growth rate of 7.5%, we compute the present value of futures payout as a constant growing perpetuity. The only input missing is totals payout this year, which we can calculate as 50% of its earning, 30% by dividends and 20% by repurchases. The present value of the company's payout is value of total equity. To obtain the price per share, we divide the value by number of shares outstanding. So what are they doing? So $860 million is the earnings right now. Out of that, 30% you will pay in dividend, 20% you will pay in share repurchases. So overall, you're paying 50% of the earnings as share repurchases and dividends. So that is 430 million. So we use this formula, present value equals 430 million share repurchases and dividends divided by cost of equity 10% minus 7.5% growth of dividend. So it comes to 7.2 billion. So this is the total value of firm's equity. Now you divide it by number of shares and you get per share value. So per share value is 7.2 billion divided by 217 million shares outstanding. So $79.26. Okay. Using the total payout method, we did not need to know the firm split between dividends and share repurchases. We considered them together. To compare this model with dividend discount model, note that this company will pay a dividend of 30% on 860 million, right? That is $1 per share for a dividend yield of 1.5%, and expected EPS, dividend and per share. So growth of this firm is equals to RE minus dividend yield. So it is 8.5%. So what is happening is, since the company is doing some share repurchases, the future dividend growth rate is going up. It was assumed to be 7.5% here, right? Because of share repurchases, the future dividend growth rate goes up. It goes to 8.5%. So this growth rate exceeds 9.5% growth rate of earnings because share counts will decline over time owing to share repurchases. The bottom line was, whenever you do share repurchases, the future dividend goes up. Next is discounted free cash flow model. It determines the total value of firm's productive assets to all of its investors, both equity and debt holders. So we have discussed enterprise value. Enterprise value is equals to market value of the company, market value of equity plus debt minus cash. Okay. So to estimate firm's enterprise value, we compute the present value of firm's free cash flow FCF available to pay all investors. So free cash flow for the firm is EBIT into 1 minus tax rate plus depreciation minus capital expenditure minus increase in working capital. And then V0, we calculate present value of future cash flows, and then we compute per share value by adding cash and subtracting debt and dividing it by number of shareholders. So it's a 3-step process to calculate. So what happens is we are using free cash flows. Why are we using free cash flows? Because some companies do not pay dividend. So it is better to value them using free cash flows rather than dividends. And dividends are unpredictable. So how do you do it? First, you calculate free cash flows. Okay. How do you calculate free cash flows? You take EBIT. Okay. You deduct taxes. Then you add back depreciation. Then you deduct capital expenditure. And you deduct increase in net working capital. So you take EBIT, you deduct taxes, you add back depreciation because depreciation is a non-cash expense. You deduct capital expenditure because capital expenditure you create an assets, but in actual cash flow position you are spending it. Then you deduct increases in working capital. Whatever you get is known as free cash flow to firm. Okay. Second step, calculate present value of free cash flows. How to do that? Generally, it is FCF, free cash flow to firm, divided by weighted average cost of capital, minus growth of dividend. Okay. Third step, you find, so this is present value of the total firm. Then you find present value of equity or price of or value of stock. Let's call it value of stock. How do you do it? You take this, whatever you calculated, let's say it is value of firm V0. So you take this V0, you add back cash, you subtract debt, and you divide the whole thing by shares outstanding. So this is the process. You, from earnings before interest and tax, you deduct taxes, you add back depreciation, you deduct capital expenditure, you deduct increases in working capital, you get free cash flow to firm. Step number 2, you calculate present value of free cash flows. How do you do it? Whatever you calculated in step 1 divided by weighted average cost of capital minus growth rate of dividend, and finally that is a value of the firm. You add cash, deduct debt, and divide it by share outstanding, you get value of stock. So this is the process of valuing a firm based on discounted cash flows. So since we're discounting the cash flows to all investors instead of equity, we use weighted average cost of capital divided by R WACC, right? Same, so it is like a dividend discount model. So formula is free cash flow to the firm in the next year divided by weighted average cost of capital minus growth rate of the free cash flow, right? You can rewrite it if the current cash flow is given, right? 1 plus growth rate in cash flows into current cash flows divided by weighted average cost of capital minus growth rate. So let's do an example. So Nike had sales of $25 billion in 2012. Suppose you expect its sales to grow at a rate of 10% in 2013, but then slow down by 1% per year in long run. That is characterized by the apparel industry. Based on Nike's past profitability and investment, you expect EBIT to be 10% of sales, increase in net working capital requirement to be 10% of any increase in sales, and capital expenditure equals depreciation expense. If Nike has $3.3 billion in cash, $1.2 billion in debt, 893 millions of share outstanding, tax rate of 24%, weighted average cost of capital 10%, and what is the estimate of Nike stock? So we estimate Nike's future cash flows by constructing a pro forma statement. Furthermore, we need to calculate a terminal value for Nike at the end of explicit projections. Because we expect Nike's free cash flow to grow at a constant rate after 2018, we can compute a terminal value. The present value of free cash flows during year 2013 and 2018, and the terminal value will be total enterprise value. From this value, we subtract debt, add cash, and divide it by number of shares to find share outstanding. So how to do it? So 2012 is given sales, right? Then project sales each year. Sales are growing by 10% each year, means 10% in 2013, 9%, 8%, 7%, 6%, 5%, and 5% here on. Okay. EBIT is 10% of sales. So 10% of sales is EBIT, 10% of sales is EBIT, 10% of sales is EBIT. You deduct taxes from it. Taxes is 24%. So 24% is tax, 24% is tax, 24% is tax. You add depreciation, you deduct capital expenditure. Both these things are not given, so we leave it as blank, right? Depreciation equals capital expenditure, so they nullify each other. Then you deduct working capital, that is 10% of sales, so you calculate that. You get free cash flows. Once you have free cash flows, then you can find value of the firm. Now, whatever you means, the growth rate is different till 2018, but growth rate after that is 5%. So you can find a terminal value of the firm here and then discount it back to today's term, then discount each of these cash flows to today's term so that you get a total value and then you add them up. So because capital expenditures are expected to equal depreciation, lines 7 and 8 in the spreadsheets cancel out. We set them 0. Given our assumption of 5% constant growth rate after 2018, it should be 2018, and weighted average cost of 10%, we use the equation value in 2018 equals cash flow in 2018 plus 1 plus growth rate, RVAC minus growth of free cash flow. So 1.05 divided by 0.01 minus 0.08 into cash flow in 2018 is $58 million, right? So this is $58 million. You discount it back to today's term. All other cash flows, you discount them back to today's terms, right? You get $48.88 million is the value of firm. Now how do you find value of stock? You add cash, you deduct debt, and you divide it by number of shares. So 42 plus 3.3 minus 1.2 divided by 893.6 gives you $50 per share. So the total value of all the claims, both debt and equity on firm, must be equal to present value of all cash flows generated by the firm, in addition to any cash it currently has. The total present value of cash flows to be generated is, and it has million in cash. So subtracting the value of debt plus adding cash gives you value per share. Value per share in this case is $50.34. Now, two important things about valuation model. They are only good at time they are made. As the time goes by, the data and assumptions used in the model will change, and so will the value. They use projections of what will happen, but these projections are subjected to a lot of error because we project things. Connection to capital budgeting. The firm's free cash flows in a particular year is equal to sum of that year's free cash flows from the firm's current and future income projects. The firm's enterprise value is total value that the firm will generate from continuing its existing projects and initiate. So what does it mean is, how does it link to capital budgeting? Capital budgeting we are going to discuss in future class. But as a manager, if you can increase the firm's value by adding all projects that generate in positive net present value. How do projects generate positive net present value? If the total inflow from the project is greater than cost of those projects, then you increase firm's value. Many forecast, example, future sales, operating expenses, taxes, capital requirement are necessary to estimate free cash flow for the project and consequently the free cash flow to the firm. Advantage is estimating free cash flows gives us flexibility to incorporate any specific details about future prospect. Disadvantage, some uncertainty surrounds each assumption. A sensitivity analysis shows how firms calculated value changes with respect to changes in input. So this model is extremely sensitive to whatever assumptions go in, right? We assume that 10% of sales is EBIT. It may change, right? Then we assume growth rate. We assume cost of working capital, the total cost of average working capital. So all these things change. That is why this model is extremely sensitive. Example, Nike's EBIT was assumed to be 10% sales. If EBIT increases to 11% change, the value of stock will change a lot. Example, if it increases to 1% sales, we can compute the value like we did, right? So it comes to $55.50. So there is a difference of 10%. So if you just increase the profit margin by 1%, the share price can jump by 10%. The value that you calculate jumps by 10%. So this model is extremely sensitive. So Nike stock is fairly sensitive to changes in assumptions about its profitability. A 1% permanent change in margin affects the firm's share price by 10%. Another application of valuation principle is methods of comparables. A method of comparable. So what are we going to do? We looked at dividend discount model. We looked at free cash flows. Now we are looking at, can we value a firm using a comparable firm, right? So whatever ratios that go for a comparable firm, we are going to use that to value our firm. Another application of valuation principle is method of comparable. In a method of comparable, an estimate of the values firm is based on value of other comparable firms or investments that are expected to generate very similar cash flows in future. Consider the case of a new firm that is identical to an existing publicly traded firm. The valuation principle implies that two securities with identical cash flow must have same price. If these firms will generate identical cash flows, we can use the market value of existing firm to determine value of this new firm. We can adjust for the scale of difference using valuation multiple. A ratio of firm's value to measure of firm's scale or cash flow is valuation multiple. So the first one that we are going to, there are 3 or 4 multiples that the book discusses. The first important one is price earnings. Then we will look at enterprise value multiples and other multiples like price to book value, price to sales, industry specific ratios. So price to earnings ratio is one of the most famous valuation multiple that the industry uses. Most common valuation multiple usually includes a basic statistics computed for a stock. Share price is divided by earning per share. So whatever market price is there, you divide it by earning per share to get this ratio. Now you can use trailing earnings or you can use forward earnings. So how is it calculated? Market price of the stock divided by earning per share. Now you can use past 12 months earnings, that is trailing earnings, or you can use 12 months projected earning, that is forward earnings. So Trailing earnings, a firm's earning over prior 12 months can be used, or a forward earning, that is a firm's anticipated earnings over the next 12 months can be used. The result is you can either use trailing PE, a firm's PE ratio calculated using trailing earnings, or you can use forward PE, a firm's PE ratio calculating it using forward earnings. For valuation purposes, the forward PE is generally preferred as we are most concerned about future earnings. PE ratios are related to other valuation techniques. In case of constant dividend model, we had dividend divided by R minus G. We can divide it by EPS. So forward PE is equals to price by earnings, or price is given by D1 divided by R minus G. So forward PE also equals to dividend payout rate divided by cost of equity minus growth rate. So this is theoretical way of calculating forward earning. Whatever dividend payout rate is there divided by RE minus G. So Amazon.com and Sears are two retailers. In 2020, Amazon stock had a price of $130 and forward earnings of $2. Sears had a price of $20 and forward earnings of $1. Calculate their forward earnings. So we can calculate the forward earnings by dividing share price by EPS. So forward earnings for Amazon is 53. Forward earnings is for Sears is 11. Amazon's PE ratio is higher because investors expect its earnings to grow more than Sears. So if you find two comparable companies, one is having significantly higher price earning ratio, the difference can be attributed to future growth. So if investors are thinking that one firm is going to grow faster than the other, then they can assign a higher growth rate to that firm. That in that way, forward earnings can be higher. Although both companies are retailer, they have very different growth prospects as reflected in their PE ratios. Investors in Amazon.com are willing to pay 53 times that year's expected earnings because they are also buying the present value of high future earnings expected by the growth. Given the information reported on Bloomberg, it seems investors were correct. The forward earnings per share has risen to $12 for Amazon and its stock price was about $1,600 per share. Unfortunately for Sears, the forward earning per share had dropped to minus 11.95 and the stock price has gone down. So sometimes whenever you're comparing firms, if you see that some companies have higher PE ratio, it doesn't mean that the company is overvalued. It means that the company can grow a little bit faster. That is why investors are assigning higher multiples. So PE ratio relates exclusively to equity, ignoring the effect of debt. Enterprise value uses measures of earnings before interest and tax. So enterprise value multiples calculate value of total firm. PE multiples only calculate value of stockholders, right? So we'll also discuss enterprise multiple. So instead of price divided by earnings, we use EBITDA, right? We can use actually three things. We can use EBIT, we can use EBITDA, or we can use free cash flows. Because capital expenditures can vary between years, most common way to calculate enterprise value multiple is using EBITDA. So earnings before interest, tax, depreciation and amortization. So how to do that? So enterprise value multiple is EV by sales. EV is nothing but value of the firm divided by EBITDA. We saw value of a firm is free cash flows divided by weighted average cost of capital minus growth rate. So if you compute this formula, it comes to free cash flow to the firm divided by EBITDA divided by weighted average cost of capital minus growth rate. So let's use it. West Coast Porting is an ocean transport company with EBITDA of 50 million, cash of 20 million, debt of 110 million and 10 million shares outstanding. Transport industry has a multiplier of enterprise value to EBITDA multiplier, EV by EBITDA of 8.5. What is one estimate of firm's enterprise value? What is corresponding estimate of stock price? So West Coast enterprise value is 50 million into 8.5, 425 million. Then we calculated EV enterprise value from, because EV by EBITDA is known, we know EBITDA, so we calculated EV enterprise value. Okay, because we have to derive stock price from it. So we first calculated enterprise value. 50 million is EBITDA into 8.5 is EV by EBITDA, so EV comes to 425. So value of the whole firm is 425 million. We subtract debt, add cash is equity value. If the stock price is equity value divided by number of shares outstanding, it should be 34.50. If we assume that West Coast should be valued similar to the rest of industry, then 425 million is a reasonable estimate of enterprise value, and 34.50 is the reasonable estimate of stock price. However, we are relying on assumptions that West Coast expected free cash flow is similar to the industry average. If our assumptions are wrong, so is our valuation. There are other multiples that can be used. Multiples of sales can be used if it is reasonable to assume margins are similar in future. Price to book values of equity can be used for firms with substantial tangible assets. Price to book value is relevant in terms of banks. Banks work on assets, so if the assets of banks grow, so does their profitability. So price to book value is a multiple we use mostly with banks. Some multiples are specific to industry. Example, in case of cable TV, we calculate enterprise value per customer, or in case of even tech companies, we calculate value per customer. Limitations of multiples. Firms are not identical. Usefulness of valuation multiple will depend on nature of differences and sensitivity of multiple to differences. Differences in multiples can be related to differences in expected future growth rate, risk, and differences in accounting convention. Because if you're comparing an American firm with an European firm or with some international firm, then the accounting would be different in these two countries. So it is very difficult to compare them. Comparables provide only information regarding the value of firm relative to other firms in the comparison set. Cannot help determine whether an industry is overvalued. Example, in internet boom, most firms were overvalued in the time period 1999 to 2000. Comparisons with discounted cash flows. Valuation multiple does not take into account material differences between firms, talented manager, more efficient manufacturing process, patents on new tech. Discounted cash flow method allows us to incorporate specific information about cost of capital or future growth. So what is the potential to be more accurate? So the final word, no single technique provides, and we have discussed multiple things. We have discussed dividend discount model, free cash flow model, multiplier models. So no single technique provides a final answer regarding stocks to value. Practitioners use a combination of these approaches. Confidence comes from consistent result from variety of these methods. Now next is information, competition, and stock prices. Information, so in what does this mean? All possible information is reflected in stock price. If there is some good news regarding stock, it will be reflected in stock prices will go up. If there is bad news regarding stock, it will be reflected in stock price and stock price would go down. For a publicly traded company, the market price should already provide very accurate information regarding to value of its shares. A valuation model is best applied to tell us something about future cash flows or cost of capital based on current stock price. Only in relatively rare case in which we have some superior information that investors lack would it make sense to second guess the stock price. So what it means is markets are efficient. It is very difficult that stock prices are not reflecting good or bad news. Suppose this industries will have free cash flows of 40 million. Its weighted average cost of capital is 11%, and it is expected free cash flows to grow at 4% per year. Then you're somewhat unsure of the precise growth rate. Has 10 million share outstanding, no debt, 20 million in cash. So we can calculate the current value is $55. How would you update your beliefs about dividend growth rate? If we apply growing perpetuity formula, the free cash flow is 4%. We can estimate a stock price. If the market price is higher than estimate, it implies that market expects a higher growth rate than what we assumed. If the market price is lesser than our estimate, it implies that the growth rate is going to be lower than 4%. So applying the growth rate formula, we calculated this price. The share price should be $59. The market price is 55. Therefore, most investors expect free cash flows to grow at a slower rate than our assumption. Given that $55.33 is the market price of the stock, we should lower our expectation for free cash flow growth rate from 4% unless we have strong reasons to trust our estimate. Next is efficient market hypothesis. Efficient market hypothesis implies that securities will be fairly priced based on their future cash flows given all information that is available to investors. So there are different levels of market efficiencies. If a market is weak form efficient, then public information is reflected, like past information is reflected, right? If market is semi-strong efficient, then past information as well as all public information is reflected. Then if market is strong form efficient, past information, public information as well as insider information is also reflected. So public easily available information available to all investors includes information in news reports, financial statements, corporate press releases or other public forms of data. Private or difficult to interpret information is one that only insiders have. So stock prices generally react to public information. Suppose that Pfizer announces that it is pulling Viagra from the market. As a result, its future expected free cash flow will decline by $850 million per year for the next 10 years. Assume that Pfizer has 500 million shares outstanding, no debt and cost of equity of 8%. If this news comes as a complete surprise to investors, what would happen to stock price? Now this is a bad news, so stock price should go down. Now how much should it go down? In case we can use free discounted cash flows, right? So they have given RVAC is equal to cost of equity of 8%. The effect on Pfizer's enterprise value will be lost of $850 million per year for the next 10 years. We can compute. So 850 million into 1.081 divided by 1.08 to the power 10. So present value of $850 million at 8% for the next 10 years. So it is $5.754 billion. Thus the share prices should fall by 5.704 billion divided by 500 million. So share price should fall by $11. So what have they calculated? They have calculated loss per year, projected it for the next 10 years and calculated the present value of that loss. Okay. Because this news is public, its effect on the firm's expected free cash flow is clear. We would expect the stock price should drop by $11 per share. Private or difficult to interpret information. So Snowy Pharmaceuticals has just announced its development of new drug for which the company is seeking approval from Health Canada. So it depends on what Health Canada does, so which is difficult to estimate. If Health Canada approves this drug, the prices will go up. If Health Canada doesn't approve this drug, the prices will go down. So if the drug is approved, future profits will increase by $15 per share. If the announcement comes as a surprise, the likelihood of firm's approval, Canada's approval is 10%. So announcement should lead to $1.5 increase right now. And if the drug is approved, then the price goes up. If the drug is not approved, the price goes down. Over time, investors will make their own assessment of the efficacy of drug. If they conclude that drug looks more promising than average, they will buy the stock and the price will go up. If they think that drug is not as efficient, the prices would go down. At the time of announcement, uninformed investors do not know which way it would go. Lessons for investors and corporate managers. Consequences for investors. So must have some competitive advantage, expertise or access to information known to only few people, lower trading costs than others. If stocks are fairly priced according to valuation models, then an investor who buys stocks can expect fair compensation for the risk that they take. And implications for managers. So it is important as a manager to do all projects that increases value for shareholders. How do you do it? You will add projects that have inflows, the benefits from the projects, which are higher than outflows, the cost of the project. So focus on NPV and free cash flows. Avoid accounting illusions because eventually they catch up. Use financial transactions to support investments. Efficient market hypothesis versus no arbitrage. An arbitrage opportunity is a situation in which two securities with identical cash flows have different prices. Because anyone can earn a sure profit, in this case by buying the low price stock and selling the high price one, we expect investors to immediately exploit these opportunities and thus they disappear. Thus in a normal market, arbitrage opportunities will not be found. There is no reason to expect efficient market hypothesis to hold perfectly. Rather, it is best viewed as an idealized approximation for high competitive markets. Okay. So what does this mean? That markets are generally efficient. So if you're trading a lot, more or less you're going to lose behind, means your returns will be lesser than market. And this has been shown by research. The traders who trade a lot generally lose more money than traders who don't trade often. So trading is expensive because of commissions and differences between bid and ask. Given a difficulty of finding over and undervalued stock, you might expect individual investors to trade conservatively. So traders who trade less make more money in the market. And this has been proven by research. However, a study of trading behavior of individual securities at discount broking firm found that individual traders trade a lot. That is why 50% more than the average, and then they lose money. Overconfidence, tendency of individual investors to trade too much based on mistaken belief that they can pick winners and losers better than investment professionals. Implication is that investors who trade more will not earn higher returns. Performance will actually be worse because of trading cost. Then investors also have a tendency of sticking up with their losers and selling off their winners. So you should avoid that. Investors tend to hold on stocks that have lost value and sell stocks that have risen in value. So a good rule to follow by is you should trim your losers as soon as they start losing. Means if a company is performing bad, you should get rid of it, irrespective of how much loss you take. And you should stick with winners until they're winning. So if a company is doing well, not the stock price, the company's financial statements, cash flow. If a company is doing well in financial statement and cash flows, you should stick with the company unless it starts performing bad and trim your losers. Research suggests that this effect arises due to investors' increased willingness to take on risk in the face of possible losses. May also reflect a reluctance to admit mistakes by taking a loss. From a tax perspective, this behavioral tendency is costly. Capital gains are taxed only when the asset is sold, so delaying a tax payment reduces its present value. Capital losses are tax deductible, so investors should capture the losses as fast as possible. Keeping losers and selling winners might make sense if losing stocks would outperform the winners going forward. This belief does not appear to be justified. If anything, losing stocks that investors continue to hold underperform the winners they sell. According to one study, losers underperform winners by 3.4% over the next years. Investors' attention, mood, and experience. Individual investors are not generally full-time traders. They have limited time and attention. They are more likely to buy stock that have been in news, advertise more, had very high trading volume, or recently had extreme high or extreme lows. Investors' mood affect investors' behavior. Annualized market return at the location of stock exchange is higher on sunny days and lower on cloudy days. So investors' mood and stuff affects stock returns. Investors appears to put too much weight on their own experience rather than considering historical evidence. People who grow up and live during a time of high stock market returns are more likely to invest in stock. People who grow up in recessions, they are more likely to be conservators. Okay, and this completes the chapter.